Everyone. We are going to be working, I am going to be working problems on a special order. We worked these problems in the earlier section and not in the later section. So here's a quick video. You can use it as practice. So we're gonna increase level of difficulty 1, 2, and 3, right? So it's a level, I would say 1.5. It's fairly simple. It's within capacity. It's a special order. We have capacity to make 10,000 units, and we have normal sales of, look it up, 8,000. So we have 2,000 units available to make, and we receive a special order for 1,030. So we are okay, right? 1,030 units. So normal sales 8,000, the special order 1,030, total of 9,030 within capacity. All we want here is a positive contribution margin. We get a positive contribution margin, we'll take the order. If not, we do not. So that will determine whether it's an increase or a decrease in operating profits. So let's take a look. The sales price of the special order is 550. And then let's take the relevant cost of making an extra unit, and that will be the variable cost. And just let's read and figure out if the marketing costs are relevant for this case. If it doesn't say anything, it means that they are, so we're going to use them. We're not being told that we're not going to incur any marketing costs. That means that we will. Okay, so every single variable cost here matters. Direct materials 130, direct labor 60, manufacturing overhead 105, and marketing is variable. So for each extra unit, we're going to be spending $95. So let's see if we have, what is the contribution margin for this transaction? We have 550 minus 130 minus 60 minus 105 minus 95. It looks like we're still making 160 per unit. So if we are going to sell 1,030 units in the special order, the total increase in profit will be 160 times 1,030, 164,800. So it looks like A is the correct answer. All right. Now, what happens? Just draw a line here. Case number 2. Let's increase the level of difficulty. Now, still the same problem. We still have 2,000 units available. So let's just copy. Special orders also for 1,030. So the same terms. But what is going on? Suppose that Cradle will not have to incur variable marketing cost. Okay, let's just copy and paste this. Actually, this. So we're going to have a few changes. So since we don't have to incur marketing costs, we're just going to clear these sales. Okay. The only relevant cost is 130, 60, and 105. But we have to buy a machine that will cost 10,300, and we're not going to have any further use. So it's only if we take the special order that we are going to incur $10,300. So this question is asking, what is the minimum that you would accept? Okay, so in this case, there's a question mark. Okay, what will be your minimum sales price that you would take before you say yes? So now we have one less from the previous scenario. We're not going to have marketing costs, but we are going to have avoidable fixed cost. Avoidable fixed cost. What is the avoidable fixed cost? It's 10,300. Why is it avoidable? Because we will only spend 10,300 if we provide the special order. Right. So how much is the avoidable fixed cost per unit? Well, let's compute it. So the total fixed cost is 10,000 we're gonna allocate $10 per unit, right? Cost over driver, $10 per unit. So the avoidable cost per unit is 10. So in this case, we want to break even. We don't want to lose money, but how much is it that we're not going to be making, because this is the minimum. Okay, so it's the sum of all these numbers. Okay, so let's add them up. It looks like it's 305 D. All right, so this is avoidable fixed cost that we're adding to the mix. All right, now last one. Now we are probably going to be compromising capacity. Let's see. So in this case, we have, again, capacity of 10,000 and normal sales now are 9,000. Okay, so unused capacity at this point is only 1,000. Okay, spell that. Unused capacity is 1,000 units, but the special order still 4,030. Okay, it doesn't say it here, but it's the same problem. It means that we're exceeding capacity. All right, so let's do the analysis without the special order and with the special order. So let's start without the special order. What is our regular contribution margin per unit? Well, we sell, regular selling price is to 945. Okay, 945. So the contribution margin per unit, okay, we have sales price 945, and the variable cost is the sum of, actually we had it before, but it's okay, I'm just gonna do it again. The 130 plus the 60 plus the 105 plus 95. Total variable cost is 390. So a regular order has a contribution margin of 550. And we're gonna sell regularly 9,000 units. Okay, so the total contribution margin is the 555 times the 9,000 units, 4,995,000. Now, if with the special order, let's just throw a line here. You know, we decide to take the special order, we are going to have to pull from regular sales, okay? Because the special order is for 1,030. So we have regular sales or normal sales as the special order. And total capacity. So we have total capacity of 10,000. Special order is 1,030. And then we have regular sales would have to be the 10,000 minus the special order. So we're selling 8,970 to regular customers, which we're making $555 per unit. Okay, so this is the contribution margin per unit. And this is units. This is total. Okay, the special order we figured out up here. In the special order, we have a contribution margin of 160 per unit. Okay. What is going on with the marketing cost? Whoa, we're not incurring marketing costs. So let's compute it again then. We have the special order that it's selling for 550 minus the relevant cost per unit. So we can use the step in number 2, right? We had the 130 minus the 60 minus the 105, 130, 60, 105 minus 10. The 10 is the avoidable fixed cost that we computed in step number 2. Okay, so this is your sales price in the special order minus all the relevant cost. Okay, you get a contribution margin of 245. So in this case, let's compute regular sales times contribution margin, and then we're going to add contribution margin for the special order. Let's add these two together and see what we get. All right, so it looks like we make more profit, so it's going to be an increase. And let's see what the difference is. We have a difference of this minus this 235,700. So it looks like the answer is D. All right.